Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, welcome to the middle of the week, Wednesday the 9th of August. This is Peter Lewis with Money Talk, one of the most listened to financial podcasts in Hong Kong according to Pod Status. You can find the show on Substack, Apple Podcasts, Google Podcasts and Spotify by searching for Peter Lewis's Money Talk. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. And that's where you'll find my daily newsletter, which contains a lot more business and finance information from across Asia to go with the show. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China has reported a far worse than expected double-digit plunge in exports and imports in July. The drop pointed to falling demand overseas and in China. Exports from China slumped for the third straight month and by 14.5%. That's the steepest decline since February 2020, and imports to China dropped by 12.4% year-on-year in July. Exports from the Philippines climbed 0.8% year-on-year to a 7-month high of $6.70 billion in June. That was the second straight month of an increase in shipments amid a jump in sales to China, which is the country's largest trading partner. Meanwhile, imports to the Philippines fell the most in almost 3 years, dropping 15.2% year-on-year. Italy's right-wing coalition government has stunned investors with plans for a windfall tax on banks. The country's Deputy Prime Minister announced the 40% windfall tax on banks that have recently profited from rising interest rates. And the government said it would use the expected $2.2 billion to fund relief for families hit by rising interest rates. And Moody's has cut the credit ratings of 10 small and mid-sized US banks and placed several other Wall Street banks on downgrade watch. Among the smaller lenders receiving an official ratings downgrade were M&T Bank, Pinnacle Financial, BOK and Webster Financial. And major lenders, Bank of New York Mellon, US Bancorp, State Street, Truist Financial, Cullen/Frost Bankers and Northern Trust are now under review for a potential downgrade. On today's programme, I'm joined by Kuijs, Chief Asia Economist at S&P Global Ratings, and John Schofield, Managing Director of Tempus Investments. And with a view from Japan is John Beirne, Vice Chair of Research at the Asian Development Bank Institute.
Peter Lewis's Money Talk.
On Wall Street Tuesday, weak bank stocks weighed on the major indices after Moody's cut the credit rating of 10 regional lenders and put 6 other major banks on downgrade watch. The KBW Bank Index was down 1.4%, having lost almost 4% in early trading. The S&P 500 dipped 0.4% to end at 4,499, bringing its month-to-date loss to almost 2%. The Dow recovered from losses of 465 points at the low of the session to close down 159 points or 0.5% at 35,314. The Nasdaq Composite retreated by 0.8% to 13,884, extending its loss in August to 3.2%. Investors retreated to the safety of Treasury bonds following a quartet of global risk-off catalysts, including Chinese trade data, Italy's surprise windfall profits tax on banks, Moody's downgrade of US banks, and Country Garden's coupon payment miss. The 10-year yield flirted with the 4% level, but ultimately closed above it, falling 7 basis points to 4.03%. The US dollar index was 0.5% firmer on a risk-off day, having been up 0.7% at its best levels of the day. The yen was the G10 underperformer after soft Japanese wage data, falling 0.6% to 143.3. The renminbi fell by as much as 0.4% to 7.2263 yuan per dollar in offshore markets. That's its weakest level since mid-July following the poor Chinese trade data, and this morning it's declined further to hit 7.2379 renminbi in offshore markets. Hong Kong stocks tumbled following the release of China's trade data and after Country Garden missed 2 debt payments. The Hang Seng Index dropped 354 points or 1.8% to a 2-week low of 19,184, led by falls in the real estate and healthcare sectors. The tech index slumped by 2.8%, and on the mainland the Shanghai Composite was 0.33% lower at 3,261. Chinese real estate developers posted sharp falls after China's former largest property developer Country Garden missed coupon payments on 2 international bonds on Sunday in a sign of mounting liquidity pressures. The $500 million bonds, due in February 2026 and August 2030, fell to 13 cents and 11 cents on the dollar respectively, after reports of $22.5 million in missed coupons. Shares of Country Garden tumbled 14.4%, and its property management affiliate Country Garden Services dropped 9.7%. Long 4 fell 4.9%. And at the open this morning, we're expecting more losses for the Hang Seng, futures pointing downwards by about 150 points, that's 0.8%. The index projected to open just above 19,000.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's join our guests. We have with us Louis Kuijs, Chief Asia Economist at S&P Global Ratings. Good morning to you, Louis.
Morning, Peter.
And also with us is John Schofield, who is Managing Director at Tempus Investment. Nice to see you, John, as well.
Yes, hello, good morning, Peter.
China's reported a far worse than expected double-digit plunge in exports and imports in July. Exports slumped for the third straight month. They fell 14.5% year-on-year. That's the steepest decline since February 2020, at the start of the COVID pandemic. That follows a 12.4% drop in June, far worse than forecasts. China's exports to the US plunged by 23.1% year-on-year. That's the 12th consecutive months of declines to the US. Those to the European Union fell by 20.6%. And exports to the ASEAN countries, which is China's largest trading partner, fell by 21.4% according to the data. And shipments to other markets, including Japan, South Korea, Taiwan, Brazil and Australia, all dropped by double-digit percentages too. And on the import side, imports dropped by 12.4% year-on-year in July, worse than market estimates of a 5% drop, worsening from a 6.8% fall a month earlier. And that was the fifth straight month of lower purchases. Louis, let's get your thoughts, first of all, just the overall picture that this trade data is telling us about both domestic demand and the state of global demand as well.
Yeah, Peter. So, on the export side, I don't really know exactly why the forecasts were so much more positive. Global trade is still in a rut. We know that also. We also already knew the July data from, Taiwan and South Korea. So I'm not so surprised on that. I think the main disappointment is on the import side, where even if we adjust for the fact that import prices, like all trade prices, are falling quite a bit at the moment, year on year. But even correcting for that, we still are left with very weak import levels in China, and that is reflecting still quite weak domestic demand in China.
John, let's get your thoughts as well, and then we'll dig into the numbers a bit shortly.
Yes, I mean, the import figures must presumably reflect, rapidly slowing construction activity and the like in China because of the property debt crisis and so on. So, in a sense, I'm not surprised to see that. The other thing interesting, we've seen exports to America, the US, falling quite steadily, but a new one is the decline in exports to Europe as far as I'm concerned. I suspect this is all part of the trend for what's it called?
This is the de-risking.
So-called de-risking,
yes.
friendshoring and all the rest of it.
Is that what we're seeing here, do you think, John? Do you see
it's one of several factors. I couldn't say which is the dominant one, but I think that's possibly the most interesting one, where we see, for example, investment into Mexico on the border of the US, obviously, is booming. Really, Mexican economy is booming because, including Chinese companies, are building factories there to manufacture for the US market.
Mm-hmm. I mean, Louis, at the beginning of the year, trade had started to recover a little bit, but it looks like all that improvement now has been unwound, and we're back to where we started from, aren't we, at the beginning of the year, before sort of China sort of reopened. It's a bit disappointing, this, isn't it?
Yeah, so I guess there are two things, right? So first, if if we want to look at what is happening to China's exports, we have to dig into what's happening on the demand side, right, globally. And we've been disappointed. Like a few months ago, everybody was still expecting the semiconductor cycle to turn around mid-year. That's not really happening. And more generally, there is disappointment on that global trade front, so like global demand. But then if you go to the China's import side, that is reflecting, the disappointments in China.
Is this exclusive to China, or are we seeing other countries in Asia? I mean, South Korea's trade data, Taiwan's trade data hasn't been great either, has it, in recent months? So it sort of suggests that maybe it's not just a China problem, but is China doing worse than maybe other economies in the region?
No, as I said at the very beginning, like South Korean and Taiwanese trade data were as weak, actually weaker than China's in July. So that is, in part because they are even more exposed to that semiconductor cycle. I would say, as John said, there is a medium-term trend going on, de-risking, shifts in supply chains, but that's a medium-term thing. Like the cyclical part is really a disappointing global trade cycle, which is affecting China's exports, and then within China, still quite subdued domestic demand, especially as concerns the import-intensive parts of China's economy, which are real estate and corporate investment, like capital goods, machinery, and stuff like that.
So this presumably is going to test China's ability to hit its growth target, isn't it? Because if we've got falling exports, that leads in turn to weaker production, and then the slumping imports, that's highlighting lower domestic demand. This is all going to subtract, isn't it, from overall growth in GDP?
Yes, certainly must do. In fact, it was drawn to my attention that nominal GDP in US dollar terms in China is shrinking, and when we see almost every sector of the economy in decline, whether that's cyclical or medium term, you wonder how you get to 5% growth. It baffles me. So maybe Louis has some insight in that.
Well, we talked before over here as well, Peter, on the Chinese growth data. There are issues on the GDP side, but some of them we won't be able to resolve at the moment. I think they will broadly meet their 5% growth target, but that is still a bit of a disappointment because everybody expected them to vastly outperform this year. It was meant to be a target that would be easily achieved, and now they may end up struggling it, and so that reflects the fact that the recovery has lost momentum, and so that's why they are trying to reinvigorate that recovery with a little bit of policy support.
Presumably, the de-risking that's been going on is being reflected in these numbers, isn't it? It's the exports to the US down 23%, exports down to the European Union almost 21%. Is this de-risking taking its toll?
I would say, China's exports is a relative bright light it's a relative strong point still in the economy. If you look at China's global market share, it has hardly budged, and it is still higher than 3 years ago. So that would not be my worry. This is about the domestic economy.
And still running a trade surplus as well. With the US, it's about $30 billion in July. So it's going up.
Peter, name me one large economy with which China does not run a large surplus. I'm not sure of anyone, like maybe a few Middle Eastern economies.
So how do we explain then that countries like the Philippines, their exports increased in July? Not by a lot, but nevertheless they did go up. What's the Philippines doing that's different from China?
I'm not a deep expert on the Philippines, but I do think that the Philippines had been struggling more than other economies with COVID. Even last year, so this is in part a little bit an improvement on the supply side there.
So what does the government do here? I mean, this is a difficult issue to fix, isn't it? Because it's not just in the hands of the Chinese government. It can't just fix by its own sort of global demand. So what does it do to try and offset this, if anything? Is there any policy measures that it could take?
John should also be welcome to chip in. I would just say, again, I wouldn't worry so much about China's exports. I would worry much more about the domestic demand side. If you look at China's exports, yes, there is, foreign firms are changing their supply side arrangements, but Chinese, like the exports from more domestically oriented Chinese supply chains, if you look at all these green energy products, including EVs, they're doing quite well. I'm not worried about Chinese exports.
So it's the imports then that we've got to focus on, and the domestic economy. But President Xi Jinping seems to have quite a high tolerance for a weakening economy at the moment, doesn't he? He seems to be much more focused on whether or not China's becoming more of an innovation-driven economy. He's said it in several statements, hasn't he, that he sees that as much more indicative of China's strength than GDP numbers.
Yes, and come around to the. I see US is just announcing its the basis for its export controls to China in high-tech areas, and the struggle for dominance in well, it's not a struggle. US has a massive lead in these leading-edge technologies, as we know, and China's very keen to get its hands on them, and so that's where the kind of geopolitical struggle, if you like, is centred. But I still think the more mundane things like how they're going to get out of this property and debt crisis and get consumer confidence. We know China, personal savings in China. Very, very high levels. People just don't want to go out and spend. They're very worried about, how they're going to take care of themselves. We've got high unemployment and so on. How they're going to take care of themselves and, health care and so on. So, again, the sort of basic workings of the domestic economy need to be looked at.
So if Louis, if we follow your advice here, focus on the import side, that's the worrying side here, that the import numbers do suggest that the domestic picture is weakening quite rapidly, isn't it, in the last sort of month or so. So what can we expect? Because it doesn't look like we're going to get this sort of big bazooka of stimulus. That the Chinese government just doesn't seem to want to do that. And then you combine that with the property sector, the news we've had on Country Garden, that seems to be getting worse as well. What can they do? Yeah,
so we don't expect, we're not going to get a big bazooka, but we kind of knew that, right? So that's not a surprise. I personally read the most recent Politburo statement as relatively constructive, as expressing a willingness to actually move a bit on the fiscal front and especially also on the housing front. There was an absence of that phrase that is often used about houses are for living, not for.
They removed that, didn't they? From
and
the statement.
Removing that together with some other language on we need to take into account the changes in demand and supply suggests that they are moving to a more growth supportive stance in the property sector. As you said, it's not going to be big bazooka like, but I do think that they are moving the policy stance towards more growth support.
But focusing more on these import numbers. I mean, the imports, they're at the lowest level now since the start of the year. So presumably Beijing will have seen this. They will notice this. They can't sit back and do nothing, can they? In the face of this, because we'll talk about it in a moment. We're going to get the inflation data later today. We may have on top of that the economy slipping into deflation.
Yes. Well, the import figures are really just the flip side of the slowdown in property and infrastructure development, as we know. So I don't think that's the symptom rather than the cause. So really, you've got to look at the cause. They've got to find a way of clearing, the overhang of unsold or unfinished properties. They've got to get the market moving, get liquidity back into the market. And it may take quite a while, and
like
they'll probably have to.
We're talking years here.
I think so. Yeah, I mean, if you look at sort of Evergrande as being emblematic of that was the most big problem in itself, but it's in a sense, the tip of the iceberg, or at least the top third of it. So yes, incremental measures. They'll have to experiment with different incentives to get people confident enough to buy properties and get the unfinished properties finished. So but they can't. There's huge supply out there,
and not enough buyers. Even if they complete them,
enough.
People might not want to buy them.
So just sort of recycling a few sales into more new developments isn't going to work.
And they've got to deal with the developers themselves, haven't they? We've had this news now that Country Garden, it used to be China's largest developer by sales. It's not anymore. I think it's number 5 or 6. But nevertheless, it's missed payments on 2 bonds on Sunday. Now, that's not technically a default yet, because it has about a month, I think, doesn't it, of grace period before it's declared in default. But nevertheless, if this is happening to Country Garden, presumably no developer is safe.
Well, I wouldn't say no developer is safe, but
not many.
Certainly we know this problem is very widespread, and don't forget the LGF fees as well. So they really need to look at the structure, the structure of the domestic finances of the local governments and things like that, and how that can be.
Well, we have got some information on that as well. These local government financing vehicles, they missed payments on a popular type of short-term debt last month. A total of 48 of these LGF fees are overdue on commercial paper. They typically have a maturity of less than a year. That's up from 29 in June. The missed payments amount to about $259 million, which is more than double June's value. Now, I should stress, none of these local government financing vehicles have actually defaulted on a public bond yet, but nevertheless it's presumably putting a lot of scrutiny under their finances, and again it just reduces the ability, doesn't it, of these local governments to be able to finance themselves and to dig the local economy out of a hole and provide support measures for the local economy.
Yes, as I understand it, their main source of revenue is land sales, so clearly there aren't going to be many new land sales coming up. So, it's a question of their revenues, how they're going to finance themselves going forward.
I mean, Louis, I don't want to be trying not to be too gloomy here, but nevertheless, this is a horrible, vicious circle that's developing, isn't it? Of declining imports, land sales declining, local government financing vehicles struggling to raise debt, China potentially on the verge of deflation. This is not a good picture, is it?
No, it's not a good picture, but I think, as you said, Peter, there is at the moment, a change has taken place, right? Like national security has a larger weight in the overall setting of policy, and short-term stimulus just to beef up growth in the short term has lost its popularity. I really don't want to paint a positive picture on China's short-term growth outlook, but we also should not, run too fast. It's not as if China's economy is collapsing. It's just that it's not growing as fast as it used to, and we see a reluctance to prop it up.
So we're going to have inflation data out today. It looks like, according to the median forecast of economists anyway, that the consumer price index will have fallen about 0.5% year on year on July. It will be about flat month on month. Maybe the producer price index, that is already in deflation, isn't it? It's been falling for 8 consecutive months, but maybe it might improve a little bit according to the forecasts. But how much weight are you putting on this data, Louis?
I almost would like to turn it around. I mean, how big of a problem is it? Food prices are falling and commodity prices are falling, right? And on the PPI index, China shares the issue of falling PPI with many other countries. The global commodity prices are having their impact on the PPI. On the consumer side, yes, food prices are falling. If you look at core inflation or prices of services, they're pretty stable. Yeah, we have a very weak economy, so we don't have that price pressure that you have in the US. But the fact that consumer prices are not rising rapidly, that's not the end of the world.
So really what you're saying here is, because a lot is being made about whether or not China has fallen into deflation. Even the authorities, don't like talking about it. But from what you're saying that even if it has, it's not really a big problem. We shouldn't focus so much on this.
But why are we so worried about deflation? I don't mean the Chinese authorities, but why are we, who look at the economy, worried about inflation? We worry when it leads to a negative spiral between falling prices and falling wages. Wages are not falling in China, so I wouldn't worry too much about that.
John, what are your thoughts then? How concerned would you be if the number shows that China is in deflation on the consumer price side, or are you with Louis and wouldn't be concerned at all?
Again, I think it's a symptom rather than a major issue. So to that extent, I'd side with Louis. So we're going to have falling property prices, for example. So ultimately, that's deflation. That's the risk is on pressure on the debt side. But governments or entities can't rely on inflation to reduce their liabilities in real terms. So that's the downside as far as I can see.
Are we already, though, in this spiral that you say what will become a problem is if it was in a spiral of consumers pulling in the horns, reducing their spending, in turn, producers, manufacturers cutting back as well. It's not just food that's falling, is it? We're seeing across the property sector, for example, prices being cut for rent, for furniture, for home appliances. Are we in danger of falling into that very spiral that would make it a problem? Unlike when we did have a temporary decline back in 2020, there was some deflation, wasn't it? But it was mainly food. Pork prices were the main reason. Isn't this more broader and widespread now?
Well, how to stimulate domestic demand is the biggest issue. On the manufacturing side, consumer goods and white goods and motor vehicles and all this sort of thing. There's partly because of the decline in demand domestically, the overcapacity is showing up in exports, exporting at ever lower prices, and that deflation is heading west. You look at the state of some of the manufacturers in Germany and Sweden and so on. In those areas, they're really struggling against Chinese competition. The competitions are beating, as Louis said earlier, on the export side. For that sort of thing, China's doing pretty well, relatively, or very well, relatively. One thing I saw yesterday or the other day that China has the capacity to make 40 million vehicles. I'm not sure it was just EVs or vehicles, but when actually domestic demand is somewhere between 20 and 25 million. So that surplus, 15 million, is finding its way onto world markets. And we know there's a big export drive going in particularly in motor vehicles. So that's a kind of interaction between Chinese deflation, if you like, or overinvestment, very high levels of production.
But on this particular issue, I would argue that this is not going to be a short-term thing. The prowess of the Chinese EV sector and the way in which it's going to make life really hard in Europe and other countries is going to be with us for a long time. Because if you look at these most successful Chinese EV companies like BYD, they're actually making really good profit. So it's not that they're selling their products at a loss. It's just that they're reaping tremendous economies of scale at the moment, and that is helping them, and that will continue to help them.
So you're not worried that we are close to this deflationary spiral that would then become a problem?
Well, I personally am not so worried about deflation to the extent that I'm not worried that we're going to see wages fall. We are not seeing wages fall, and that will limit the kind of deflation that has a bad name, which is that spiral.
The Japanese type inflation that we saw in the 90s.
Yeah.
And this is very different, though, from that situation, really, isn't it? This is not the same at all, although it's often compared as being like Japan in the 1990s, or fears that it could be.
I mean, I would agree with John that if you're looking for trouble in China, it is on the balance sheet side, and on, like with companies facing deflation pressure, that is worsening their debt in real terms. They have difficulties to repay it. That is more of an issue for me than CPI falling for a few months.
Let me just get your thoughts on banks, because there's been a lot of news on banks as well today. Moody's has cut the credit ratings of 10 small and mid-sized US banks, placed several others on downgrade watch. And then in Europe, we had the news that the Italian government is going to impose a 40% windfall tax on banks that have made profits out of this rising spread in interest rates, the spread between what they borrow at and what they lend at. What do you make of this? Is this, are we gearing up for a sort of a big credit event here somewhere?
No, I don't think so. Well, they're two, I think, quite separate issues. But on the Italian side, I have a certain amount of sympathy with the government and the banks in the UK. And so, well, I mean, what they've been doing is outrageous, really. Raising, obviously they raise their lending rates but hardly give anything back to savers. And we've discussed this on previous.
But this is not the right way to do it, is it?
Balance. No, it's
windfall taxes don't really work.
Yeah, it should be. Well, let's assume it's a quick fix. I mean, it should be a regulatory matter, really, a matter for the consumer agencies as well. Are customers being treated fairly, and they're not in a lot of cases. I mean, moving on to the US thing, I think that's quite different. We know that the smaller banks in particular are under stress simply because they for the opposite reason, really. They're forced to compete with treasury bills or whatever for customer deposits. So, we've seen massive growth of funds being withdrawn from banks and going into money market funds. So this is quite it's a natural market response.
Sort of delayed reaction, isn't it, to what happened back in the spring? It's sort of like this tends to suggest that maybe the problems with these regional banks are not over yet.
There may be more. There may be more to come. I don't know, but at least the Fed has shown that they will do what they need to do to make sure there aren't any bank failures that cause depositors to lose their money.
I guess you've seen in the US quite a bit of divergence between the fortunes of the big banks and everybody else, right? The big banks are reaping in record profits because they benefit from this current environment, whereas it's like you have the US banking system is quite diverse, right? We have a
too big, really, too big and diverse, isn't it?
We have
fragmented.
It's very fragmented. We have a few very big ones, and then a huge number of really small ones, and those small ones are under pressure in the current environment. And that may not go away so easily. Is
this going to be a drag on markets? Do you think this pressure on banks, both in Europe and in the US?
It probably will weigh on sentiment. It may not, be a real serious macroeconomic issue if you look at the weight of these banks, but it probably will weigh on sentiment.
And the other stock in the news, Country Garden, how big an issue is that? Missing coupon payments on 2 international bonds on Sunday. That dragged the Hang Seng down overnight, along with the Chinese trade data. We just seem to be getting hit by a lot of risk-off events all coming to us at the same time at the moment, don't we?
Yeah, well, as we discussed earlier, all these sort of things, particularly the Chinese developers and so on, it's all been in the pipeline for some time. So it's going to pop up here and there, a new one. I mean, I couldn't speak to that particular case, but certainly the stock market. We see the stock market kind of desperate to grasp any single piece of good news, but we have a quick rally as we did in Hang Seng about a week ago, only to be slapped back by these kind of incidents. So it's very, very it's a setback for the stock market generally, I think.
Okay. Well, thank you very much for coming in. A big news day today. Lots of things to talk about. It's great to hear your thoughts on that. Some very interesting opinions there. That was John Schofield, who's Managing Director at Tempus Investment. Louis Kuijs, who's Chief Asia Economist at S&P Global Ratings.
Peter Lewis's Money Talk.
I'm joined now by John Beirne, who is Vice Chair of Research at the Asian Development Bank Institute over in Tokyo. Very good morning to you, John.
Good morning, Peter. How are you?
I'm very well, thank you. Now, the Bank of Japan said this week it's got a significantly long way to go, quoting directly from the minutes of its last meeting, or in fact, it's not really its minutes, it calls it its summary of opinions. Now, during the last meeting on the 28th of July, the Bank of Japan maintained its benchmark interest at minus 0.1%, but said it was going to conduct yield curve control with greater flexibility, and this former upper end of the band at 0.5% has now become a reference point rather than a rigid sort of limit. The Bank of Japan, John, it seems determined to get this message across to the markets, doesn't it, that it's not easing monetary policy, even though the markets say, yes, you are.
Yes, that's correct. I think at the last meeting, the Bank of Japan also increased its projection for inflation for the course of 2023 to 2.5%. So it is clearly understanding that inflation is a concern in Japan. It's remained above 3% for quite some time now. I think the real question remains as to whether the level of inflation that prevails is at a sustainable level. And that's something that is stopping the Bank of Japan from going down the route of tightening. Of course, it has tweaked its yield curve control policy, as you said. And I think there are concerns around market functioning, given the inflation outlook, and also given volatility in the yen that we've seen certainly recently. And, it's continued to depreciate in recent days, actually, and recent months, and particularly during July. And this would also be one of the factors taken into account, I believe.
I mean, the problem is it says it wants to see sustainable inflation. What I don't understand is what are the signals that it would use to decide that inflation has now reached that sustainable level as opposed to being transitory or temporary? What is it looking for to decide?
Well, it's looking very closely at developments with nominal wages. I think, this will be a key factor which will determine the extent to which rises in domestic demand will be sustainable, and therefore inflation can become sustainable over the medium to longer term. Okay. As we've seen in recent months, nominal wages are still lagging the level of inflation. So it's a little bit concerning in this regard as to whether there's certainty on the inflation outlook.
Well, we saw the data yesterday. Average cash earnings in Japan increased by 2.3% year on year. Now, that has slowed from 2.9% in May, but it's still above what the market was expecting. But as you mentioned, Japan's nominal wage growth, which is obviously taking into account inflation, has fallen behind the 3.3% consumer inflation rate. So this is in effect now the 15th straight month of declines for people in their inflation-adjusted real wages. So the Bank of Japan is sort of trying to get inflation up, but at the same time, it hasn't got wages up to keep pace with it, which is not a good situation, is it, for the Japanese consumer?
Exactly. The level of inflation is continuing to affect purchasing power, of course, and it's also preventing tightening in monetary policy by the Bank of Japan. So I think there are challenges in really stimulating domestic demand in that regard. I think we should also remember that, the external side of the economy is an important contributing factor to growth. And we're not seeing a pickup in that regard, despite the level of the yen at the moment. And weaker external demand is also a factor related to that, of course.
And we're seeing that in the spending numbers. We also had personal spending numbers yesterday. Household spending declined in real terms by 4.2% year on year. That was worse than what the market was expecting, worse than the 4% drop the previous month. So personal spending down for five months so far this year. People spending less on things like furniture and household utensils, down almost 18% year on year. It all seems to be having a sort of self-fulfilling impact, doesn't it?
Yes, I think that, as inflation would persist and as nominal wages would continue to lag behind that rate of inflation, then we're going to see some reaction in household spending, which, as you say, has declined in recent months. That said, I would make the point that domestic demand and consumption in general relatively resilient to the very large shocks that we've seen over the past couple of years. I think the headline number in terms of household spending, needs to be looked at a little bit deeper. So I think particular items will be reduced within that, whereas other types of factors that are not directly related to significant inflationary effects may not have the same impact.
Are Japanese consumers, are their spending patterns changing in the same way that we're seeing maybe in the US and Europe, in that they're not buying things, they're not buying manufactured goods like they were during the pandemic when they couldn't go out, so they were ordering things on online platforms, stocking up their homes with new furniture and gadgets. Now they're buying services and experiences. They want to travel, go on holiday somewhere, go to the cinema, go out to restaurants. Are you seeing a pickup in that sort of thing in Japan as well?
Well, I think that there's certainly more activity in recent months. And this is, I would say, related to the influx of tourists since May. And this is having a positive impact on the service sector in Japan, on employment. And that, of course, will have spillovers to spend by Japanese consumers as a result of that. So all of these things are sort of interrelated. I think it's difficult to come up with a general overview of there's less expenditure on manufactured goods and these types of issues. It would require deeper analysis, but I certainly would say that, whilst more can be done to drive sustainable domestic demand, it has remained quite resilient despite the numbers that we're seeing at the moment.
And what about the overseas environment? We saw in the Chinese trade data yesterday, overseas demand looks particularly weak. I mean, it's not just China that's been suffering with its trade. We've seen it in the South Korean numbers, the Taiwanese trade data as well. What sort of impact is that having on Japan?
Well, of course, there will be knock-on effects from that, not only in Japan, to all of the trading partners associated with these economies. I think that the external environment remains challenging for many economies. And, there's a close eye on what's happening in the US, of course, at the moment, and other parts of various advanced economies, because these places will be destinations for many of the exports from the economies in Asia. So I think this is closely related to what we're seeing as regards the outlook for the external environment.
I mean, I can't work out whether the bad Chinese trade data was specific to China or whether it's sort of, a regional problem. Because if you look at the Chinese trade data, there were double-digit declines in exports to the EU, to the US, also to Asian countries, to Brazil, to Australia. Everything seemed to get hit. But I'm not sure whether it's any worse than what we're seeing in the rest of Asia.
Yes, well, I think in the case of China, there are, of course, additional disruptions to trade related to restrictions and, fragmentation in that regard. So I think there are probably more unique trade patterns in respect of Japan relative to other parts of Asia. But of course, there will be knock-on effects regardless of whether economies are directly linked to restrictions and sanctions and these types of issues.
So this is the de-risking that you're talking about that the US and the EU is now following. But if China is being hit by that, and that's being reflected in the data, it also suggests that this is going to be an ongoing problem, that the trade exports from China are not going to pick up in the coming months.
Well, it really underscores the need for well-diversified global supply chains. And this is the real mechanism through which one can address these types of frictions that would be emanating from one particular nation, for example, and to basically smoothen the disruption of that effect to other parts of Asia and other economies that might be trading partners with these economies.
One other thing I want to ask you about for the impact on Japan. We're seeing now a sustained rise in long-term treasury yields, although they did pull back a bit today because there was a lot of sort of de-risking sentiment going on in the markets. But last week, certainly, the 10-year bond yield in the US was quite firmly above 4%, and we haven't seen that on a sustained basis since the global financial crisis. As bond yields rise in the US, particularly at the long end, what impact does that have on Japan and on global investment flows and Japanese investment flows?
Well, of course, we had the downgrade in the US, and this has led to, some initial negative implications for stock markets. In terms of what it means for Japan, I think that it's difficult to really disentangle because what happened in the US coincided week in the Bank of Japan policy. So both of these factors may have contributed to an uptick in Japanese bond yields. And this will have implications, of course, for the level of the exchange rate and also the extent to which the yield curve control policy will be tested further by speculators. And I think there's concern, certainly in the near term, really on whether we will see further effects on the exchange rate given the inflation outlook and given what we're seeing in global markets.
The Japanese yen is looking very weak, and I've heard people say that, if Japanese bond yields rise, then suddenly people might start to reconsider repatriating money back to Japan. But I'm wondering if that's really going to happen, because there's still a wide differential, isn't there, between US and Japanese rates? That's right. I mean, for a long time now, the level of the yen has been driven by what's happening abroad, particularly in relation to the spread between US and Japanese interest rates. And this is something that still prevails at the moment. We're just seeing different drivers of this spread in recent days. And I think that, until we would see, some reduction in that yield differential, we will remain in a weak position as regards the yen, although there will be some volatility around that depending on different market moves, different risk on, risk off scenarios, which is what we're seeing at the moment in terms of volatility. The level at the moment is a little bit concerning at 143. So I think that this is down to really speculation and market activity, which is testing the yield curve control policy. John, it's always a pleasure to talk to you. Thank you very much for coming onto the programme this morning.
Thank you, Peter.
That's John Beirne, who is Vice Chair of Research at the Asian Development Bank Institute over in Tokyo.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with the show. I'll be back tomorrow when my guests will be Andrew Ferris, the CEO of Economist Advisory, and James Wong, Chief Executive Officer at Cathasia Securities. With a view from Taiwan is Ross Feingold, Business Development Director at SafeBro Group. Please catch me tomorrow.
Money Talk